I have the privilege of being able to moderate this first panel today. And the two experts that we've invited both have a deep understanding of how the rules and institutions that govern our financial system shape economic inequality, which in turn affects our entire economy. During the Great Recession, we learned how bailing out asset holders while practicing austerity for everyone else led to those at the top recovering quickly, but not so much for the rest. We also learned how inequality renders monetary policy less effective as a macroeconomic stability tool and the limits of the toolbox that our monetary authorities have. Now, of course, during this pandemic, we're seeing how important the Federal Reserve has become, not just for traditional monetary policy, but making very important decisions about the future composition of our economy. Of course, the exhibit one for this is the CARES Act, which directs a large degree of fiscal policy responsibility over to the Fed, something that we're going to be talking about here today. How should we think about this? Do we need to reform the structures of our financial system, the role of the Fed in our economy, or do we need to develop new institutions? So we're going to dig into these questions today with our two panelists, Mehrsa Baradaran and Emma Coleman Jordan. So Mehrsa is a professor of law at UC Irvine, at the UC Irvine School of Law, and she's a member of Equitable Growth's board of directors. She is an expert on banking law, financial inclusion, inequality, and the racial wealth gap. Her book, The Color of Money, Black Banks and the Racial Wealth Gap, was recognized with a number of awards and received significant media coverage. This, of course, includes a recent trip back in February to Louisville, Kentucky, where the whole city read The Color of Money, and my in-laws bragged to me about how awesome the event was before they even knew that I knew Mehrsa. So I was excited to tell them that she was on our board. Emma is the J. Crilley Kelly and Terry Curtin Kelly Professor of Business Law at the Georgetown University Law Center. Emma is best known for establishing the field of economic justice in legal theory and for her really important work in financial services and civil rights. Her textbook called Economic Justice, Race, Gender, Identity, and Economics is a capstone to a series of articles, chapters, and books she's written on this subject. I could not be more thrilled to be able to have this conversation here today with these two fantastic scholars. Before we get to my first question for them, I want to take just a moment and give a big shout out to my team at Equitable Growth. So many people helped to organize this event today, and I know I am very, very grateful. And we also want to give a special shout out to all of our funders who help make our programming possible. So without further ado, I want to turn into our first question. And so I'm going to start with you, Mehrsa, although I think I'd like you both to weigh in on this. So Emma, you can chime in after, or we can go for a follow-up if you'd like. So there is a perception that the Fed intervenes in the economy, that the Federal Reserve's interventions in the economy are just seen as bolstering, quote, the market, which is viewed as sort of as a neutral thing, right? We need to protect the market. We need to, focus on maintaining the economy. But this presumes in some ways that the market is natural, or that the Fed doesn't have that its activities don't actually have an effect on other policy goals, such as around distribution or compositional questions, or things around thinking about climate change, or how we might build a faster payment system for individuals and families, a whole range of issues that really are not sort of wrapped up in the way that we often think about how the Fed is interacting. So Mehrsa, can you talk for a moment about how you think about these questions and whether or not you think that deploying the Fed is a neutral choice?
Yes, that's a great question. And I think the short answer is it is absolutely not neutral. The Fed's charter mission, in the progressive era by President Wilson and the coalition that created the Fed was very much, a mandate to, look at, monetary policy and do that, but also to look at, the equity and access to the tracks on which the economy runs. And over the last 50 years, with the rise of sort of this market fundamentalism, it has really just focused on monetarism and tinkering with inflation factors. And so I was actually just, at another talk where we were talking about how to more sort of democratize monetary policy. And someone was like, well, aren't you worried that if we if we make the Fed more, open to public, push more democratic, that we would, that would be bad because we would lose something, right? Some expertise and technical stuff. And I'm like, what makes you think that the Fed is not, politically influenced? And that, I think, is the biggest myth, is that it is this neutral, technocratic response to these market principles in the abstract, and that when it, buys up QE or gives interest on reserves or tinkers with certain metrics, that it is just, the market at large, when it is not. It is a very clear, certain market. It is certain people in that market. And the way that the Fed's monetary responses over the last several decades have massively increased these gaps and created wealth for asset holders in certain markets and deprived it from others is absolutely a political decision. It was not framed as such, but the effects were very much felt by people in the economy. And so we absolutely need to look at those things. And I'm not saying everyone should vote on all of those metrics, but there has to be voices at the table say, well, how did these rounds of QE affect the Black-white racial wealth gap? How do they affect employment as a central issue?
That's thank you. Emma, would you like to weigh in on this question as well?
Yes, absolutely. I agree that the Federal Reserve is governed by a set of ideological principles and commitments. They are committed to market determinism, and they have reinforced that ideological commitment with the people who are hired and who run the show. The economists, the neoclassically trained economists, are the people who they rely on for ideas and for implementation. And so that leads to a kind of orthodoxy that excludes considering individuals, excludes considering race. I remember I did a research paper a few years ago where I looked at all of the Federal Open Market Committee minutes that were available at that time. And I did a search for race in the period leading up to the financial crisis in 2008. And I did a Boolean search, meaning, race in all of its various forms. Do you know how many hits I got? 0. And so it's no surprise that the ideological commitment of the Fed to ignore race as a variable in looking at growth and looking at the well-being, economic well-being of Americans, produce the kind of cognitive narrowness and blindness that led to the financial crisis. And the corollary principle here with this idea of market determinism is the idea that it's all neutral and that financial innovation is good. That's what brought us these horrible mortgage products, the predatory practices that Alan Greenspan refused to rein in, when the Fed was the only one with statutory authority to do that. So that is really important, to think about the Fed as being under the sway of an idea. Now, it's interesting. Many people, I think, will remember this classic clash between Alan Greenspan and Congressman Henry Waxman, where Waxman asked him, this is after the financial crisis, he said, were you under an idea? What were your operating principles? And with a little bit of comeback, Greenspan said, yes, we all have some way of thinking about how the world operates. But the bottom line of his answer was, I was wrong. For 40 years, I've been working under the assumption that we have markets that will correct, self-correct, and that regulation is not necessary government intervention. So that's the first thing to know about the Fed. It is under this set of ideological commitments, and it's going to be hard to root out. I've got some ideas for how to root them out, and if you want to go to those now, I can talk.
Well, let me just take a pause so we can kind of do a little bit of back and forth. I think that is, I mean, this idea that what the Fed is protecting and the models implicit in how they're thinking about the economy, their role in it, it's interesting to kind of start our conversation there in all of your answers. You know, one of the things that and I do want to get to solutions in this question. Like I know that you both have big, bold structural solutions to think about for what to do with the Fed and financial institutions more generally. But could we pause as you're thinking about answers, so as you go into that? One thing that I have been, watching very carefully, and I know you both have as well, is because the Fed now has these new powers because of the CARES Act and because of the crisis. Many people are concerned that the Fed is really acting at this point more as a fiscal agent, making decisions about how much aid to give to specific firms and the like in ways that it hasn't had to do before. And that opens new doors in terms of how policymakers are thinking about the role of the fiscal and the role of the monetary authorities. So maybe if you could weave that into the answers in terms of how you're thinking about structural change. And just to break it up, so I'll go back to Mehrsa and then I'll go back to you, Emma. We can do a little bit of back and forth.
Yeah, I showed that clip that Emma mentioned on the Greenspan, and his quote was, "There was a flaw in my thinking," and it's a classic understatement of theory. And I go back to the Joan Robinson quote, the classic economist who was forgotten during that era, where she says, ideology is like breath. Everyone has it, but you can't smell your own, right? And so I think that was part of the thing, is like there is this non-ideological spin. But as far as your question of how the Fed acting as a fiscal agent as opposed to not is part of, I think it is an indictment of our failures in democracy. I think it's impossible to get anything passed in Congress. I was listening to Mitt Romney talk just last night, where he says, the thing with the Senate is the party in power, and he is in the party in power, has all the power. And you can't get anything on the floor unless you're the party of power. And Mitch McConnell just decides what gets heard, even if there's a majority consensus. If he doesn't put it on the floor for a vote, we don't get it. There's all sorts of these problems with our democracy. And so we end up relying on these other things. Another thing is securities fraud. I think Matt Levine is someone I follow on the econ side, and he says everything is securities fraud. And so the way that we filter these social concerns through the securities fraud framework and other ways, right? We talked about Andrew Ross Sorkin has this famous idea of we can get gun control through putting pressure on banks to not lend to certain things, or we can tamp down on this stuff. All of that stuff, I think, is a symptom that our democracy is broken, that we're relying on Fed monetary policy to do fiscal things that we all, I think, want and can't get through the channels that are supposed to be doing that. So I think that's the fundamental issue, is we don't have a one vote, one person democracy. We have a real sort of capture of a lot of these agencies. And so I think we really, so we can talk about how the Fed can do better on doing fiscal policy, and I'm here for that, and I have lots of ideas there. But it really is, we have to recognize that this is a failure. There are better institutions for this. The same, I think, can be said of using credit policy for stimulus. Historically, we've used these credit policy, and part of it is because of this constrained thinking on budgets and deficits. So we'll just say, okay, we'll just do credit guarantees. Fannie Mae and Freddie Mac are on the balance sheets, are off the balance sheets of the federal government, but they're in conservatorship. And that's a problem that we have to look squarely and not pretend that is not on the government's balance sheet. So I think all of this stuff is part and parcel of this rot within the center. And those are the people responsible to do fiscal policy.
So would you suggest then, Mehrsa, just to follow up, so you said you have a bunch of ideas for fixing the Fed, but do you think that fundamentally this is, it sounded like what I'm taking from what you just said is that fundamentally we need to fix Congress. Is that what you would you stand by that statement?
I stand by that statement. I think the Fed is, delegated. Congress has delegated their authority to the Fed, and the Fed is under the, they're working for the American people through their representatives, which is Congress, and they were, deployed in 1913 to do these mandates, and it's changed over time. And so I think either that or make the Fed democratically accountable, which is tricky. But generally, we this is a place for Congress. Or we can say, look, we have this broken system. Let's make the best of it. And that's a practical response. And I'm fine with that too. But I would rather do it democratically.
Emma, I'll turn the same question over to you.
Yeah. Okay, so the Fed has been subjected to democratic process scrutiny at several points in its history from 1913. And each time those interventions failed. The Fed, for instance, I'll take one that's more recent, 1978, we had the Humphrey-Hawkins Act, where that statute brought under Fed mandate to do full employment and not just monetary policy. And it was put on the books after a long fight to make full employment one of the specific goals. What happened? The Fed ignored every single bit of full employment policy. They simply refused to implement it, ignored it, and it was many, many years before full employment came to be a part of what we call the dual mandate of the Fed. So that's one thing. Second failure is Dodd-Frank. Dodd-Frank was intended to introduce more democratic features into the Fed decision making. One of the things they introduced was that all of their policies and special interventions in crises should in fact be a part of broad scale change. It should be applicable to more than one institution, as was the case at the beginning of 2008 when Bear Stearns and Jamie Dimon of JP Morgan Chase were the only beneficiaries of the very first rescue package. So that's what Dodd-Frank said. And the second thing they introduced in Dodd-Frank was that the Treasury Secretary should be consulted since the Treasury Secretary is appointed by the President and confirmed by the Senate. So it was thought, oh, the Treasury Secretary has this democratic link. Well, we can see with the current COVID crisis and how the Treasury Secretary and the Fed together are making transparency a joke, that we don't have the kind of democratic penetration into who is getting the money, how much are they getting, and are they in fact entitled. So those interventions for democratic change in the Fed have been problematic. Last thing I'll say about the Fed is that the Fed started as a progressive intervention in its predecessor, which was a crony structured private intervention after the financial crisis of 1907. What happened there? The original JP Morgan brought all of the boys into his paneled office and said, you're going to take this much, you're going to take that much. And they acted like a central banker. And so that was private central banking. The problem with that is there are all kinds of crony, crooked deals that were a part of that decision making, And so cronyism is a part of the Fed heritage. It's there. It is, we can see it in the PPP program. The first tranche of PPP has a blatant display of cronyism, that people who knew people, you know, I guess it was Abner Mikva who said when he first went to get a job as a student in Chicago, they asked him who sent you, and he said nobody. And the ward boss said, I don't want nobody that nobody sent. Okay, so that kind of political connection is a part of the heritage of the Fed. And you can see it in PPP, that some entities that got PPP money had to be shamed into releasing it. So you got Shake Shack, Ruth Chris Steakhouse, and even universities, Stanford and Harvard, gave money back. But that was a small portion of the corporations, publicly traded corporations that could go to the market to get money. Those corporations refused to give the money back of PPP loans. So we had shame and shamelessness. And the shameless simply said, I'm not giving it back. And these tended to be people who were connected to the president's political fortunes. One was head of the Republican Party in Illinois, and another in Dallas. So this problem is a big problem of the way in which we have democratic institutions, but we've got a history of cronyism that persists from 1907 financial crisis and the 1913 progressive replacement. We are still in cronyland, and we have these networks of people who manipulate financial results.
Yeah. So, I mean, I think that it's so interesting because as an economist, over most of my lifetime, we have been told that the Fed is really our first line of defense in times of recession. It is sort of this. It is portrayed as this neutral. It's focusing on full employment. One just little data point I wanted to add in. We were talking about, I think Emma, when you were talking about race in the Federal Reserve, is that there are actually some scholars, Jared Bernstein, Janelle Jones, who've just written a piece calling for the Fed to think about Black unemployment as the full employment metric that we use rather than the aggregate number, something that I think is well worth discussing and talking about, because we know that typically the Black unemployment rate is twice that of whites. So you're never going to get to full employment for the whole country if you're focusing on the aggregate. But I think that you both are really raising some super important questions around how we think about economic policy, the role of democracy, and then Emma, you bringing in this role of cronyism at the tail end of your answer there, so important to understanding who is this benefiting, because if it isn't benefiting the common good, the whole economy, and it's just benefiting certain actors, that certainly isn't going to bring you the kinds of strong, stable, broadly shared growth that the Federal Reserve's mandate is supposedly promising us. So I want to just I have a couple of questions here from the audience that I want to turn to. So would really like to focus on, as we kind of go through some of these questions, we have about 10 minutes left, want to focus on action. Like, how do we actually get here? So as you're thinking about answers to these questions, really focusing on how can we get from here to there? I'm curious because both of you have thought, I know, deeply on these issues. One thing that one thing that someone wrote in is that the Fed sometimes claims that questions around inequality or the racial effects of their policies are beyond their purview, right? They have that dual mandate, full employment, price stability, and nothing else matters. And can you both speak a little bit to whether or not you think that that the Fed's lack of attention to these very questions of distribution does that actually make it harder for them to fulfill their mandate? I don't know which of you would like to take that first.
Yeah, I think so. I think it does cripple them in addressing this issue of racial economic equality. As I said, the Fed really uses this shield of neutrality to avoid major problems in our economy, and that is the cumulative effect of a long, long period of racial discrimination, a lot of it government discrimination. So we had first FHA, blacks were excluded from loans, the redlining phenomenon. Homer Hoyt was the economist who set this up, color-coded it, we know that. But beyond those practices, there is an accumulation of other injuries that show their effects in the economy: racial violence, the lynchings, police brutality, employment discrimination. And the Fed has been, and still is, the most brilliant collector of data, but they don't do anything with the data to intervene in this long history of racial discrimination. So for me, it says that there is a need for a bold theory. For me, it's economic justice, which gives us the opportunity to explicitly consider economics and identity, race, gender, all of the variables that make up the human personality. And the Fed blithely ignores all of those. We're all widgets, just little pieces of the economy. So that's one thing. And the last thing I'll say is we can go back in time to pick up the FDR proposal for having an economic Bill of Rights, a second Bill of Rights. The idea of market determinism goes all the way back to Adam Smith.
Right.
So there's
So let's let
in getting older theories, and the FDR theory, economic justice, are things, tools, ideas. They're not tools so much as ideas.
So let's let Mehrsa get in on this question as well. Thank you, Emma.
I absolutely agree with Emma on this erasure of Black data. And, you know, Martin Luther King said in 1967, maybe, or 8, you know, when we talk about a white poverty, it's a depression, it's a social problem that we got to fix, right? But when we think about Black poverty, it's a societal problem. When we think about Black poverty, it's a cultural phenomenon. And he's like, the Black population has been in a state of perpetual depression since emancipation. And if you look at the numbers, right, it has been an absolute, just complete no real changes. And so you look at the recovery from 2008, so we say, well, the market recovered. Black families lost 53% of their wealth, and it did not recover. Black unemployment is low. You have every metric that you care about when you focus in on Black poverty, Black wages. There was an article today by Dave Leonhardt in the New York Times. He says the wage gap hasn't even changed since 1950, Black-white racial wage gap. And I actually don't, here I'm going to excuse the Fed, because it's not just the Fed. This is across society. This is Congress. This is economists. The profession of economics, I was going to say economy, and law. And every profession that has designed these rules has either, they went from actual explicit exploitation and exclusion to just papering it over and talking about the laws of supply and demand as though the market created these gaps. And I do try to cover that intellectual history, because I actually think, and maybe this is too bold of a thesis, but I think you can't understand the libertarian move and the neoliberal move in economics but for that moment intersecting with the civil rights demand for economic justice. And by the way, the trans sort of national Cold War sort of thinking, where they put, and there's some intellectual entrepreneurs here, Alan Greenspan being one, who was Nixon's advisor in 1967 through 68. You put any demands for economic justice, including MLK's demands that were, now we've kind of whitewashed that history, into this is communist and this is anti-capitalist. And so capitalism was used very much as a weapon against these claims. And so I think we're still in that. This is not just the Fed. And I think this is the entire economics profession, legal profession, which I'm part of, and Emma is also a leader in. We have to reckon with this in a big, big way.
So, you remind me of one of our research advisory board members is Lisa Cook, and she just has gotten a lot of attention for some research that she did that I think it's worth telling our audience about here, that it touches right on what you just said, Mehrsa, both of you, Mehrsa and Emma, that she did some research showing how hate-related violence against African Americans, against Blacks in the late 19th and early 20th century significantly harmed their applications for patents, because people stopped believing that the government would protect their economic rights, which meant that our society lost all of this innovation and ideas. Those communities lost that access to that path to engage in the economy, and our whole society lost inventions that could have propelled us to Mars, or whatever it is that maybe people would have invented that just never happened. And so you think about the devastation that this has wrought and the society-wide effects. I think it's important to add that to this conversation. So we're going to end with just a bit of a lightning round of, just to get to someone has asked really the big question here, which is, what are some practical options for a revision to the Federal Reserve Act? What are a few things that we could do? We have about 3 minutes left. So Mehrsa, you want to start first and give a few, and then we can go to Emma, and then we'll wrap up. Thank you.
Yeah, I think one of the problems with the CARES Act, and one of the things that it highlighted, is the Federal Reserve Act was meant to equalize the industry. And at the time, and I think this is a flaw in the progressive thinking at the time, and still today, in that localism and private is always better. And so even when progressives talk about it, it's reduce the monopolies and send it locally. But the assumption is that the Fed has to use banks as a middleman. So whether they be small banks or big banks, that becomes a problem. And I think that is a flawed reasoning. I think we have a central bank that has lots of tools in its power, and we do not need banks as middlemen. So the problem with the CARES Act and the PPP specifically is that you had to go through a bank to get it. Even the direct stimulus payment, you had people waiting in line for hours and hours just to pick up a check at the one ATM in Manhattan that didn't charge them an overdraft fee. You had some people who were unbanked waiting months and months who haven't gotten the check that they have to a check casher. And then on a large scale, that monetary policy, the buttons that the Fed is constantly pushing, and they know very well how to push, and they did, 2008, developed brand new sort of buttons to push, and I'm simplifying it, but, repo markets and commercial paper, and that they did all in a weekend during the coronavirus crisis. All of those go through banks and through markets controlled by banks. And so I would say the main thing is to create either a public option or public access point. And there's a variety of ways that this can be done. And I'm ambivalent as to which one. I've proposed postal banking. I was testifying in Congress on Fed accounts. The main premise being that if you have a central bank that is a public institution, make it available to the public and don't use banks as a middleman.
I love it. Emma, what's your big idea?
Yeah, the big idea includes this concept that banks are the problem, that you've got to change the channels for distribution. As people say, you can't have the arsonists being brought in to put out the fires. And that's what we do. We did it in 2008 when, in fact, the banks were the arsonists, and they were brought in to put out the fires. We had 20 banks in the entire world that were eligible as primary dealers, which is a elite group of banks with a special stability, but that also included American banks that had caused the crisis. So banks are a problem, and I would propose that we cut banks out of this distribution channel. And one of the reasons we need to do that is, did you know that with the PPP, the banks that participated in those grants, and they were grants because they were forgivable as long as the recipients complied with the requirements, those banks received a fee for handling PPP loans that was subtracted from the total amount of money that was committed by Congress. So fees are usually for risk, and those fees were simply for allowing your best friend to go to the head of the line. It's absolutely unacceptable, and so you have the problems of banks being the vectors for self-interest, self-dealing, and also the vector for exclusion and continuation of racial subordination.
Okay, subordination. That's where we're ending our fantastic conversation today. Thank you both. Thank you for all of your work on these issues, and thank you for the brilliant ideas. I'm going to hand the baton over to David Mitchell, who is our Director of Government and External Relations at the Washington Center for Equitable Growth. And yeah, I hope you all enjoyed the next panel. Thank you very much.